Good afternoon, everyone. We're Group 7, and today we will present our case study on Helen of Troy Limited, a global consumer product company best known for brands such as OXO, Vicks, Braun, Revlon, and Honeywell. Here is the outline of our presentation. We will begin with a mission statement section, followed by key issues, our questions and analysis. Finally, we will discuss recommendations, implementation plans, and contingency plans. I will start with the mission statement part, and my teammates will continue with the later sections. Our team includes members from diverse backgrounds. Juan Munoz from Colombia, Amnor Khan from India, Daniel from China, Abdur Mateen Khan from Pakistan, and myself, Celine Chen, also from China. Together, we combine international perspectives to evaluate Helen of Troy's global strategy and mission. The first part of our case focuses on Helen of Troy's mission statement. This section includes three parts: existing mission and vision, evaluation of the current mission, and proposed mission statement. I'll be covering the first three subsections for today. Helen of Troy's current mission is to acquire and build world-class brands and products that elevate people's lives everywhere, every day. Its vision states that we are led by exceptional employees who cultivate cultures and create long-term sustainable values together. This emphasizes brand excellence, improving daily life, and a collaborative, people-oriented culture that values sustainability and growth. Using the nine characteristics of a mission statement, we found that Helen of Troy's mission is broad in scope, inspiring, and concise, but it lacks reference to product utility, environmental responsibility, and technology. It covers only about 5 of 9 components, focusing on consumers, products, markets, and values. Therefore, while motivational, that current mission does not fully reflect the company's strategy priorities or ESG commitments. Our proposed mission statement is as follows. We aim to serve our customers worldwide by acquiring, designing, and marketing innovative, world-class brands and products that enhance health, beauty, and home living across global markets. We leverage advanced design and technology to drive creativity and product excellence, ensuring sustainable growth and profitability. Guided by a philosophy of mutual respect, ingenuity, and shared success, we define our self-concept as a trusted, design-led consumer lifestyle company. We demonstrate social and environmental friendly through sustainability, inclusion, and community initiatives, and support our employees by cultivating careers, innovation, and empowerment. This vision meets all 9 criteria as technology, profitability, and ESG element, and better represents Helen of Troy's global designing driven identity.
There are four key issues identified in our case. First, supply chain concentration. About 70% of Helen of Troy's products are manufactured in China, and roughly 80% of its suppliers are based in the Far East. This structure helps keep production costs low, but it also exposes the company to significant operational and geopolitical risks. If tariffs, trade restrictions, or currency fluctuations occur, Helen of Troy's supply continuity and profitability could be seriously affected. The company's limited supplier diversification has made it harder to adapt to such external shocks. Second, revenue concentration in the U.S. Although Helen of Troy sells in over 90 countries, about 79% of its revenue still comes from the U.S. This heavy reliance on one market is described in the case as potentially disastrous, while global competitors like Unilever or P&G already enjoy international scale. Helen of Troy still struggles to establish a strong presence in high-growth markets such as Asia Pacific and Latin America. The company clearly needs a more localized and region-specific strategy to achieve balanced growth. Third, decline in the wellness and health segments. Its operating income fell sharply from 94 million in 2021 to 39 million in 2022, while other divisions continued to grow. This suggests structural inefficiencies or weak innovation within the segment. Helen of Troy must decide whether to restructure, divest, or reinvest in this division to improve overall portfolio performance. Lastly, rising competitive intensity. Helen of Troy faces more than 100 competitors, including P&G, Unilever, Conair, and Clorox. These companies have much stronger marketing budgets and global distribution networks. Maintaining consistent brand identity across multiple labels is becoming increasingly difficult. What's more, price competition and brand overlap continue to weaken profit margins. Based on these issues, we developed four strategic questions. First, how can Helen of Troy diversify its supply chain beyond China while maintaining cost efficiency and product quality? Second, what strategies or partnerships can the company pursue to strengthen its international presence, particularly in Asia Pacific and Latin America? Third, how should Helen of Troy optimize its health and wellness portfolio? Should it restructure, divest, or reinvest to restore profitability? And finally, how can the firm enhance brand synergy and sustain competitive advantage against the global leaders such as P&G and Unilever? Next, we will move on to the financial analysis.
Now we're going to talk about different analyses for this case. First, the financial analysis with the income statement and the balance sheet. Income statement and financial ratios. Helen of Troy's revenue reached its highest point in 2022 at 2.22 billion, but slipped to 2.01 billion in both 23 and 24. This decline reflects a tougher market environment and growing competition. However, the company managed to improve its profitability despite lower sales. The gross profit margin climbed to 47.3% in 2023 and held steady in 2024, up from 42.9% in 2022. This strong improvement suggests that the company reduced its cost of goods sold, likely through better supply agreements, smarter product mix decisions, and greater efficiency in sourcing and logistics. Then, after the pandemic, Helen of Troy maintained solid operating performance. The operating profit margin peaked at 13.4% in 2021 and stayed healthy at around 12.3% through 22 and 24. This shows the company's ability to control expenses even when sales growth slowed. The net profit margin improved to 10.7% in 2023 and 24, compared with 8.9% in 2020, a clear sign of stronger cost control and efficiency. Overall, the company's ability to protect margins during a period of lower revenue highlights a resilient and adaptable business model that continues to deliver returns for shareholders. Now, based on the balance sheet, Helen of Troy's total assets grew from 1.9 billion in 2020 to a peak of 2.82 billion in 2022, before easing to 2.41 billion in 2024 as the company refocused operations. Over the same period, long-term debt nearly tripled from 337 million in 2020 to 893 million in 2024, raising leverage and financial risk. Shareholders' equity fell from 1.33 billion in 2022 to 930 million in 2024, likely due to reduced retained earnings and possible share buybacks. This trend shows a heavier reliance on debt financing. Now, related with liquidity and leverage, the current assets have remained steady at about 735 million since 2022, while current liabilities have declined slightly. This suggests a minor improvement in liquidity, though the company's overall leverage remains high because of the growing long-term debt. With a smaller equity base and higher borrowing levels, keeping an eye on key solvency measures such as debt equity and interest coverage ratios will be important moving forward. We will continue with internal factors evaluation and the external factors evaluation. The internal factors evaluation matrix for Helen of Troy showcases strong core competencies, including a diversified brand portfolio, advanced R&D and marketing initiatives, effective supply chain management, and solid financial base on valuable licenses and trademarks. These strengths provide a robust foundation for competitive advantage. However, there are notable weaknesses. The company's substantial reliance on Chinese suppliers introduces significant risk. There is overdependence on the U.S. market, and profitability issues remain in the health and wellness segment. Recent rises in long-term debt also signal increased financial vulnerability, underscoring areas that leadership must prioritize for improvement. The external factors evaluation matrix shows that Helen of Troy has significant opportunities. The rising global demand for household and health products, growth potential in emerging markets, consumer shifts favoring premium brands, and ongoing demand fueled by pandemic factors position the company well for expansion. Strategic international partnerships offer further avenues for growth. On the other hand, threats such as supply chain disruptions tied to China dependency, inflation, and rising input costs, intense industry competition, and geopolitical volatility present important risks. Additionally, demographic trends like declining birth rates may dampen demand in certain sectors. Successfully leveraging opportunities while mitigating threats will be key to Helen of Troy's sustained success in the evolving consumer marketplace.
Helen of Troy. Starting with the strengths, Helen of Troy has a really well established distribution network, including major relationships with major retailers such as Amazon, Walmart, Target, and Costco. Another strength is that there is a portfolio of trusted and premium brands like OXO, Per, Hydro Flask, Honeywell, and the licensed Revlon brand. In addition to that, the company has long term strategic licensing agreements, which gives it consistent brand access and competitive advantage. Lastly, the company maintains a strong financial position, which help it to support its continuous growth. Talking about the weaknesses, a major weakness would be that the company relies too much on the US market with 79% of revenue coming from the US. This makes it really, really vulnerable to changes in the US market conditions. Another major weakness would be that there is heavy reliance on Chinese suppliers. 80% of manufacturing is outsourced there, which exposes the company to supply chain risks. Helen of Troy does not manufacture any of its own products, which limit production control. Additionally, the company does not pay out dividends, which discourage some of the investors, and its wide product diversification can stretch the management attention across too many categories and areas. Talking about the opportunities, there are strong expansion opportunities in emerging markets like that of Latin America, Asia Pacific, where the demand for consumer products is expected to grow. The company can also benefit from digital transformation and growth of e-commerce through its own electronic platforms or the platforms of major big retailers. Another major opportunity is the formation of strategic partnerships and joint ventures globally. With increasing consumer awareness around the environment, sustainability focused products would be able to drive growth for the company. Lastly, the threats. One of the biggest threat would be supply chain disruptions that could arise due to some political tensions or pandemic related issues or shipping delays in Asia where most manufacturing happens. There is also a lot of competition from brands like Conair, Dyson, Procter and Gamble, Unilever. There is rising raw material and shipping costs which are putting pressures on the margins of the company. There are currency exchange rate risks involved, especially given the global sourcing. And lastly, the declining birth rates would definitely impact product demand in some categories, particularly those that are related to infants and young families. Five forces for Helen of Troy. The first one being competitive rivalry. The competitive rivalry in this industry is very high. Helen of Troy faces strong competition from brands like P&G, Conair, Unilever, Dyson, etc. Products are also similar in function, so the customers find it really easy to switch with minimal cost, which further intensifies the competition. Moving on to the second force, that is threat of new entrants, that is a bit moderate. On one hand, e-commerce has reduced the barriers to entry, allowing new brands to enter through online platforms and social media marketing. But brand loyalty, global distribution partnerships, and the scale needed to compete make it very challenging for new players to grow quickly at Helen of Troy's level. Moving on to supplier power, which in this case is moderate to high. Around 80% of production is outsourced to China, which creates a dependency on suppliers in that region. This increases the vulnerability to supply chain disruption, rising labor and shipping costs, and geopolitical risks. Moving on to the buyer power, which in this case is high due to heavy reliance on major retailers. So, large retail partners like Amazon, Target, Walmart, Costco, they account for about 50% of the total sales. This gives these retailers a really strong negotiating power and puts pricing and shelf placement pressure on the company. Lastly, threat of substitutes, which is quite moderate. Consumers have many alternative options for household products, wellness appliances, and beauty tools across both premium and budget brands. However, strong branding and product quality have helped Helen of Troy maintain their customer loyalty. This is for Helen of Troy, talking about the political forces. So, there is an exposure to the US China trade tensions and tariffs. Political unrest or policy shifts in supplier nations may disrupt operations like that of China because 80% of the production is outsourced from China. Labor laws and international trade regulations will impact the outsourcing. Economic forces would be the global inflation that is increasing the manufacturing and transportation costs. There is also an exchange rate volatility involved that will be affecting the margins because most of the production is outsourced from other nations. And economic growth in emerging markets like that of Latin America and Asia Pacific would provide expansion potential. Social forces would be consumer preference would shifting to sustainable and ethical brands. There is also a rising awareness about post COVID about the boosts of health and wellness segment. There are declining birth rates that will be affecting baby care product demands. Technological forces would be an increasing reliance on e-commerce platforms like Amazon. Growing need for digital marketing and data analytics is another technological force that Helen of Troy would have to take into consideration. An opportunity for innovation in smart health and beauty devices, as done by Dyson. Some legal forces would be the compliance with intellectual property, product safety, and environmental laws. Also, there are certain risks which would be posed by licensing agreements like that which we have with Revlon. If these are not renewed or enforced properly, they will have major legal repercussions for the company. Lastly, the environmental forces would be that there is a strong ESG and sustainability commitment, but we are still reliant on manufacturing in China. There is a rising pressure for carbon reduction and sustainable packaging, and the global focus on circular economic practices creates both compliance pressure and an opportunity for the company.
We have analyzed all the challenges and the problems that we have, and now I'm going to show you what are the recommendations that we want our company to take. First, we have huge reliance on just one country, that is China. So the first recommendation is to diversify our global manufacturing and move away from China to countries like Vietnam, India, and Mexico. This is going to increase the supply chain resilience of our company by at least 15 to 20%. Secondly, we need to restructure our portfolio. We need to divest underperforming health and wellness segment. It's a segment that is utilizing our energy but not giving us enough returns. So we need to focus on the segments that are giving us huge growth, huge revenues, and huge profits, that are our beauty and home and outdoor lines. Thirdly, we need to expand in emerging markets. We need to take our focus away from the US and take focus more on Asia Pacific and Latin American countries. And we can do this through joint ventures. Expected return is around 10 to 15% within the next 3 years if we take on these emerging markets. Fourth, we need to equip ourselves digitally. We need to move away from third parties like Walmart and Target, and we need to focus directly on the consumer. For this, we can use platforms like Amazon and Shopify. And the fifth recommendation is to become more sustainable so that we are more appealing to the investors, to the consumers, and to the ESG. We need to come up with eco friendly packaging as well as smart home devices. Our implementation plan is going to be based on our recommendations. We For our manufacturing diversification, we need to relocate at least 30% of the production to Vietnam and Mexico in the next 2 years. From 2025 to 2026, we need to do our portfolio restructuring. Like I said before, we need to divest from the underperforming segments and move those finances to our high performing sectors. We also need to go into emerging markets like India and Brazil by 2026. As for digital transformation, we need to focus on data analytics, CRM, and e commerce by 2026. And for sustainability, we need to get right away on it and we need to become a more greener company. And this is how we are going to implement our plan. So, all these things that we want to do is going to cost us money. Manufacturing diversification is going to cost us $45 to $55 million. Our portfolio restructuring is going to set us back $8 to $10 million. Emerging market expansion would be another $25 to $30 million. Digital transformation is going to cost us $10 to $12 million. Sustainability and ESG initiatives is going to cost us $5 to $7 million. And for contingency fund, we need to have $10 million. By investing this money, will increase our returns by at least 20%. For a contingency plan, to avoid our supply chain disruptions, we are focusing on dual sourcing and we need to have an inventory buffer of 90 days. Secondly, to encounter currency and inflation volatility, we need to apply currency hedging and use dynamic pricing. For our joint ventures and market entry failures, what we need to do is we need to go towards licensing and franchising model. And for our ESG compliance risks, we need to have annual independent audits. We need auditors coming to our country and seeing all the processes and give us an evaluation based on that. And for financial overextension, we need to have our debt to equity ratio at less than 0.6 or a $300 million credit buffer. So by doing all this, we'll have our revenue grow by 20%, a 30% reduction in supply chain risks. We're going to achieve this through diversification. And we will see increased operating margins, and this is going to be 15%. We are going to be diverse digitally equipped, and a sustainable company. These are the references. Thank you so much for listening to us.